Hi there, welcome to Kneppy Invest. We are at the end of July, so the next trading day will be the 1st of August, and that means I need to give a performance update to three portfolios I am tracking. Now, July, the first month of financial year 23, was a good month. We saw a nice little rebound in the markets, and this was to be expected because the markets were oversold because of what happened in June, the last month of financial year 22. It was a bad month. And July, the first month of financial year 23, was a good month. The other thing I noticed in July this year there were a few really positive trading updates from retail discretionary companies, including Mosaic Brands released a pretty good report, and Myers had a pretty good report as well. So that was a little bit of a surprise to me. I did expect retail or the performance of retail discretionary companies to be a bit down and trading updates would be negative in light of what's happening with inflation and fears that we are moving or heading towards a recession. But potentially, because unemployment rates remain fairly low, that in itself is having an effect of the mood of consumers, and they're still spending even though their confidence is fairly low right now. Now, in saying that, United States experienced another a quarter of negative GDP growth. So that's 2 quarters in a row. So that's a technical recession. However, even if GDP figures show a shrinking economy, a recession won't officially have begun unless the National Bureau of Economic Research says so. So we are in a technical recession in the United States right now, but the National Bureau of Economic Research doesn't think so right yet. I think one of the reasons behind that is because of the low unemployment levels. I think there's 8 members on that board, and they will have decisions to make over the next few months to determine whether the United States actually is in a recession, even though they're in a technical recession right now. So let's have a look at the performance of the portfolios. But before we have a look at the performance of the portfolios, just a general overview of the markets, particularly focusing on the XJO. Now, before we have a look at the XJO, I completely forgot that what are these three portfolios I am tracking? The first portfolio is a group one, and that consists of 25 to 30 companies that were chosen by viewers of this channel over a year ago. And the whole point of this was viewers had to choose a company they thought would outperform the market over the next 5 years. So this is sort of like an experiment, a 5-year experiment in regards to a completely passive portfolio. So in the group portfolio, the companies that are in there right now won't be sold, and I won't be buying any companies in this group portfolio for the next 4 years. I just want to see how a completely passive portfolio can perform over a long term. And 5 years is probably bordering on the shorter part of that long term, the way I think of long term anyway. And the other two portfolios I'm tracking are personal portfolios based off different strategies. One is a short to medium term strategy based off sentiment and the trend of the company's share price. And the other one is a long-term buy and hold, the sort of strategy I started as an investor. Now, in saying that, the total holdings, when I look at both of my personal portfolios combined, amount to $200,000. And I also own quite a few companies outside these two portfolios. So combined, my two personal portfolios I've included here account for only 40% of my holdings. So even though I might be performing quite well in one of these portfolios, does not mean my full holdings I have overall are performing well or badly. So just don't think these are all my holdings I have. Only accounts for 40% of my holdings. Now onto the XJO, and this is the monthly because I do this video every single month. So instead of looking at the daily or the weekly, I decided just to focus on the monthly. And in fact, this goes all the way back to 2006. Also includes the GFC. You can see the XJO fell from about 6,800 all the way down to 3,400. So it halved during the global financial crisis. But then the XJO has moved into this upwards channel. And every single time it gets to the top of that channel, that's when we see a little bit of a sell-off. And every single time the XJO goes to the bottom of the channel, we see a little bit of buying. The only time the XJO has moved either above or below this channel was during the COVID-19 financial panic. That makes complete sense. But the XJO at that point in time fell to the long-term trend, which is that sloping blue line right down the bottom. So during the GFC, or at the bottom of the GFC and at the bottom of the COVID-19 financial panic, the market or the XGO actually fell to the long-term trend. So in the worst case scenario, if we do see the economy move into a severe recession, I would be looking for that long-term trend as a really good support level. Right now, that long-term trend is around about 4,600, 4,700, and the XGO is just below 7,000. So I just mentioned that June was pretty bad. So we saw the XGO fall from about 7,200 to 6,600, so about a 10% drop in the XGO. In the previous 6 to 9 months, we had seen the XGO move towards the top of the channel. So it was to be expected with the XGO at the top of the channel, we would see a little bit of weakness in the market, and we exactly have seen that. And during June, the bottom of June, we saw it get to 6,400, which was just above the bottom of the channel. At that point in time, the bottom of the channel was 6,200. So I was expecting a possible move of the XGO towards 6,200, and that would be a really good buy signal, assuming that we don't move into a severe recession. So I don't know if we're going to move into a severe recession. I'm just following what the market says here. A nice little rebound in the XGO over the past month. And right now, we are in the middle of the channel. I could see us going up from here. I could see us going down. I have no idea which way the XGO is going to go from here. It's all based off sentiment. And right now, there is positive sentiment in the market, but that does not mean positive sentiment will last for the next few days, the next few weeks, or even the next few months. We might see some really negative financial data come up, economic data come out, and that could shift that sentiment from positive back to negative. Now to the performance of the group portfolios. And before we have a look at how the group portfolio is performing after the end of July, I just want to go back 1 month ago. And at the end of June, the end of financial year 22, it didn't look very good. In fact, the group portfolio was down 27%, even taking into account dividends. And at this point in time, there was only 4 companies that were in the black or had gone up in the financial year. And those 4 companies were Lake Resources, BrainChip, Unity Group, and Novonix. And the worst performers were Kogan, Alcidion, Imogen Biosystems, Zipco, and Megaport. It's not surprising that 3 of those companies that were the worst performing companies in financial year 22 have rebounded a significant amount in just 1 month. So why is that not surprising? There is actually a financial or an investing strategy where you look at the performance over the past year of the biggest companies in a certain index, and then you choose the worst performing companies in a particular year. And a lot of times those worst performing companies actually tend to be the best performing companies in the next year. There is actually investing strategies around exactly doing that. And there is the debate, an argument, it actually does work. So it's not surprising that some of the worst performing companies have seen a little bit of a rebound in the share price over the past month. So we're talking about Kogan, Zip, Megaport has rebounded fantastically well, a few other companies as well in the group portfolio. So now we turn attention to how the group portfolio is performing to the end of July. So instead of being down over $27,000, it is now down about $16,000 or 16%. So a nice rebound in the group portfolio. And instead of only having about 4 companies in the black, we now have 8 companies. So apart from Lake Resources, BrainChip, Unity Group, and Novonix, we now introduce ResMed, Talga Group, CSL, and Woolworths, all now in the black. So all have increased since the start of financial year 22. And the worst performing companies now are EML Payments, Imogen Biosystems, Credit Intelligence, Zip, even though it's rebounded quite a bit, Alcidion, and Kogan. You'll notice Megaport isn't there on the worst performing companies because of a significant increase in the share price based off a really good quality report from the company. Now, just because the group portfolio is down a fair bit doesn't mean it is performing badly. So we have to compare the group portfolio to a benchmark. The benchmark I'm using is the STW. Now, I've noticed some people, some investors, some even experts compare the performance of their portfolio to the XJO. And the reason I don't like that is you're discarding dividends. So the STW actually includes dividends. And in this, it shows you, this is from, what's it called, ShareSite, whatever it's called. And the STW has a capital gain and a dividend. So capital gain for the STW is down 6.7%, but there's 7.5% of dividends. So I really think you have to include dividends unless you have a complete portfolio of non-dividend paying companies. So in the group portfolio, dividends amount to 1.76%, capital gain at negative 16.9%, overall down 15% for the year, or for the first 13 months. Now, another thing we have to take into account here is the group portfolio and my two personal portfolios tend to outperform the benchmark in a bull market and will tend to underperform the market in a bear market. And that's exactly what we have seen over the past 7 months. So the first 6 months of financial year 22 were really good. And at one point in time, the group portfolio was up over 20% when the benchmark was only up like 5 to 7%. So if we do see the markets move back into a bull market, there's little doubt, in my opinion, that the group portfolio will significantly outperform the STW. If we remain in the bear market for a while, I think we'll see underperformance in regards to the group portfolio moving forward. Now let's have a look at my personal long-term buy and hold portfolio and the performance of this portfolio. Now, I have subtly, maybe not subtly, but I have shifted my philosophy in regards to the type of companies I'm going to be buying in this portfolio using this strategy. Now, in the past, I've been a little bit cavalier in the type of companies I wanted to buy in because I get excited about companies that have the potential for significant growth in the future, even if they are what I would consider low quality companies. So low quality companies are companies that don't make a profit, have fairly low revenue, and have no dividends. And I am transitioning to buying higher quality companies simply because I have moved into a part-time role and I want to stay in a part-time role and I want to be less cavalier with my selections of companies. So I am transitioning towards that, and I'll show you some of the purchases I've made in the past month, honoring this transition in my philosophy in regards to this portfolio. But if we focus on the best performing companies in this portfolio, the first or the best performing company that I still hold is BrainChip. And I would consider BrainChip to be a low quality company because it has no revenue at this point in time. But I do see a future when BrainChip revenue absolutely explodes. It's not an absolute that this happens, but I do see a future. So the risk rewards in regards to BrainChip are fairly significant. So fairly high risk, but the rewards are significant when it comes to that company. The other companies that have done really well in this portfolio include Ava Risk Group, which I would probably consider a lower quality company. But then we go on to Ansarada, again, probably a lower quality company simply because it hasn't been on the ASX for too long. Then we go into Fiducian, Base Resources, Closed Loop, Goodman Group, Breville Group, two companies I have purchased recently, Sequoia and SCL, another high quality company. So some really high quality companies in the best performing companies within this portfolio. And when we look at the worst performing companies, we have Zip, Electro Optic Systems, Cydev, Kogan, Orbital Group, MCS Services, Gentrack, Nanosonics, and Clinical. Now, Nanosonics and Clinical, I would consider companies, particularly Clinical, that are high quality and would have significant potential for growth in the future. But a lot of those other companies I would consider to be low quality companies. So I want to transition from owning low quality companies to mostly owning high quality companies that have dividends and will be able to grow their dividends for the future. Now to the actions or the purchases I've made in the long-term portfolio in July. No disposals. I have purchased 4 companies, but I still have $16,369 of cash moving forward. I am looking for future purchases. I have my eye on quite a few companies, including American companies. So Aristocrat, Breville Group, Goodman Group, and I've purchased more shares in Clinical Pharmaceuticals after an insane reaction from the market. Share price down 8% after the company released their Appendix 4C, and it was an absolutely stellar Appendix 4C from the company. Not sure why the share price dove on that day, but the share price has rebounded, and I think I bought in at $16 was really good value for that company. I bought into Aristocrat Leisure. So I do think Aristocrat is a high quality company in their financial performance, their business, but what they do, I probably would not consider high quality. So all about gambling. So if you do have ESG worries, maybe Aristocrat is not the sort of company for you. Breville Group, I think Breville Group is discovering, or we are discovering, that Breville Group has a significant moat, competitive advantage all around the brand. And I came to that realization watching, I think it was Billions a few years ago, when there was just one scene where Breville product was brought up in a conversation. And that's when I realized that Breville Group has a brand, and that brand is fairly significant in regards to high quality appliances. And Breville Group is experiencing some really good growth over the last few years. And I think that company has potential for significant growth over the next 5, 10, even 20 years. Goodman Group, a really good property company, the best sort of property company on the ASX. And I did find some good value as the share price had pulled back a fair bit over the past few months. And of course, I've already mentioned Clinical Pharmaceuticals. Now, onto the performance of my long-term portfolio, and tracking just slightly behind the STW. And if you don't take into account the dividends, my long-term portfolio in terms of capital gains is tracking significantly better than the STW, only down 3.2%, and when the STW is down 6.7%. But the STW has significantly more dividends, 7.43%, compared to my long-term portfolio, only 3.5% dividends. And the majority of those dividends was because of AVA Risk Group. They did a capital return because they sold one of their businesses, and we did get a fair bit of dividend from that company. But we were significantly outperforming the market during the first 6 months of the financial year 22. And then because the market pulled back, just like the group portfolio, my long-term portfolio should underperform the market, but we're catching up to the STW right now. And if we have another really good month in August, I think the long-term, or this long-term portfolio, will outperform the STW, and it will be performing better by the end of August. But again, that's assuming you have another good month in August. Now, let's have a look at my personal short-term sentiment strategy or portfolio. And this uses a strategy based off the charts, looking at the sentiment and the trend of the company's share price. And I've been using this strategy for a few years, and it has been very successful for me. And I just want to track the performance of this portfolio compared to my other portfolio using different strategies. And at this point in time, this portfolio is outperforming my other portfolio. So there is potential that I'm better suited to using this sort of strategy than the long-term buy and hold, but I just can't shake off that feeling that I want to own some companies for the long term without looking at the share price performance. Now, when it comes to this portfolio and using this strategy, I do have to be a little bit more active. And right now, Costa Group is down a fair bit, and I probably should have sold it a few weeks ago, maybe even about a month ago, because the reason I bought into Costa Group, because the share price looked like it was moving up. Costa Group is in the agricultural food, and I thought that sort of sector would be was fairly bullish at that point in time. But the share price has pulled back for some reason. I'm not sure why, but I do expect a little bit of a rebound in the share price for that company, and that's why I haven't sold out of Costa Group just yet. A few other companies I am looking at selling out include Pack Gold, Hillgrove, and possibly even Linus Rare Earths. They're all down a little bit, and the share price of those companies are not in uptrends. Now, at the top of this group, the best performing companies include John Lynn's Group, Neuropharmaceuticals, IPD Group, and even Megaport. Those are 4 companies I'm thinking I probably should own for the long term, particularly those first 3, John Lynn's Group, Neuropharmaceuticals, and IPD Group. I bought into Megaport simply because of the release of their Appendix 4C. It was quite positive, and the market reacted to that positive news, and the downtrend of the share price had come to an end, in my opinion. But I have been a little bit more active in this portfolio, and I actually have disposed of one company. So what is the one company I've disposed of in this portfolio over the past month? I actually sold out of South 32. I bought South 32 using this strategy. So the only reason I bought in South 32 2 years ago was because the share price had moved into an uptrend, and the share price kept on rising. And I sold recently just below $4 because it does look like the chart and the share price is out of that uptrend. So sentiment is shifted. The uptrend is no longer there. And the whole reason I bought South 32 was because of positive sentiment, and the share price was in an uptrend. And the 2 companies I bought in the past month include Megaport because of that positive Appendix 4C, and Ansell Limited. And this was completely based off value and the charts. The share price had moved to a really strong support level, and there was pretty good value in Ansell. And I do expect Ansell share price to possibly double over the next few years. So that is one reason I bought into that company. And even though this is a short-term sentiment or short to medium-term sentiment, I could possibly expect to own Ansell and a few other companies for the long term. And in fact, if I do hold some of these companies for the long term, that's good, because that means the share price has been in and remains in a long-term uptrend. Now to the performance of the short-term sentiment and momentum strategy. And over the past few years, I have noticed that this is the best performing strategy for me, and this portfolio is no different. Whenever I pay attention to using this strategy, it outperforms. So towards the end of last year, the calendar year 2021, I really wasn't focusing on this strategy, and it was underperforming. As soon as I started focusing on the strategy, it started to outperform the market. And right now, over the past 13 months, this short-term strategy, this short-term portfolio is up 4.1% compared to the benchmark up 0.74%. So it's quadrupling the benchmark returns at this point in time. So the question I have moving forward is, should I be just focusing on using this strategy, even though I started investing as a long-term buy and hold sort of investor, looking for some high-quality companies that you want to own for the long term? What I'm thinking right now is, because I have a super account and I can buy and sell shares in that, I might just focus on using my long-term buy and hold strategy for my super, and then my other personal accounts, I might just use my short to medium term strategy. So that's the way I'm thinking right now. I haven't absolutely decided upon that, but I think that's probably the best way moving forward for me. Now, to the performance of these three portfolios versus the STW, looking at the 13 months and also comparing it to the financial year 22 performance. For instance, the STW was down 4.25% at the end of financial year 22. Now it's up 0.74%. So we have seen a really good rise in the markets over the past month. The group portfolio down 27.25% at the end of financial year 22, now only down 15.1%. And my two personal portfolios have gone from being in the red to being in the green, both rising about 7%. So the long-term buy and hold down 7.7% at the end of financial year 22, now up 0.42%. And the short-term sentiment down 3% at the end of financial year 22, now up 4%. So I think the returns for these portfolios compared to the benchmark are going to be highly dependent on the overall market. If we see the overall markets continue to rise, I have no doubt that these three portfolios that I am tracking will outperform the benchmark, which is the STW. That's all I have for this video on the performance of the three portfolios I am tracking, the group portfolio and two of my own personal portfolios. 13 months at this point in time, we have been tracking these portfolios, and it's been a really interesting 13 months, particularly the last half of financial year 22, where we did see the markets fall by quite a bit, including June, with the markets down over about 10%, and we saw our portfolios hit quite hard because of that downturn in the market. But I have been a net buyer during July. We have seen positive sentiment move back into the market. We have seen a little bit more optimism in the market, not quite as much pessimism as what we saw in June, but that does not mean that optimism will continue into August. I think the last day of July in the United States, the markets were up there, so that should lead to a pretty good day on the Australian markets on the 1st of August. Doesn't necessarily mean it will, but sometimes when we do see the American markets up, one day Australian markets will react positively the next day, unless the American futures are down big. So that remains to be seen. If you have any questions, any thoughts, any comments, just leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.